the word crypto terrifies me. I'm like, wait a minute. You're a bank and you're taking deposits in crypto? How's that going to work out? Look, you could just take the biggest, the blue chip crypto, right? Bitcoin. It trades on nothing. It trades like the most speculative, risky thing on the face of the planet.
Wiggin. We have Dan Ferris. Dan Ferris, I've known you for a number of years. You have been studying the market longer than I have, which is interesting to me. And I'm just going to kick it off with a statement that you might not even know is true. You coined the phrase, the daily reckoning.
Maybe I did. I seem to remember that there was another fellow who came up with that. And every time somebody tells me this, I say, oh, no. I remember we exchanged emails and we went back and forth. And then this other fellow said daily reckoning. But if the evidence points to me, I mean, okay.
I think you should take the credit.
If you insist.
Yeah. Do it.
Yeah. Twist my arm. Give me the credit. Yeah.
But it's important that we're talking about this because we're looking at a similar set of credit cycle issues that led to the founding of the daily reckoning in the first place, right?
Yeah.
That's what we were doing back then. And then we had the banking crisis in 2008. And now we're facing another one. And it's kind of a cyclical, I want to say credit gets overdue at some point.
Right.
Yeah. So first of all, welcome to the Wiggin Sessions.
Thank you. Great to
right.
be here. And it's good to see you again and hear your voice. It's been a very long time.
Yeah. I think the last time we saw each other was in 1217, right? Like a long time ago.
Yeah. People don't know that's the address of a building. Yeah. Like forever ago. And if it was in that building, it had to be, 15 years or something. I mean, it's crazy.
All right. So let's talk about the experience that we've had together. What I think we're approaching right now is another banking crisis. And you've been talking about that a lot also. So let's go.
Yeah, it sure is looking that way recently, isn't it?
Yeah. Well, I mean, in the last week, for sure.
Yeah. I mean, the story is that this is about, in the case of Silicon Valley Bank, right? They had these high risk loans, and when they got the high risk loans from all these startup companies, they said, hey, we'll give you a loan, but we want all your business. So they got high risk loans and high risk deposits as well. And they thought they were doing a good thing by using the money to buy safe, and I'm using air quotes, safe treasuries and mortgage-backed securities. I mean, how could that go wrong? It could go wrong if you bought the bulk of them in 2020 and 2021, and then sat through 2022 and saw the market take 30% off of treasuries, a worse performance than stocks, and the worst performance since treasuries were invented in 1780 something. So, I mean, it was the moment. I've been telling people, for a little while now, 2020 was the peak of the biggest asset bubble in all recorded history, the bond bubble, right? Interest rates at 5,000-year lows mean bonds at 5,000-year highs in price. So there was that. Then we saw the equity markets peak in phases throughout 2021, finishing up with the S&P 500 and Dow peaking in January 2022. So that's it. Stocks and bonds peaked over that time frame, and we're now seeing what happens, right? All the startup companies that Silicon Valley Bank did business with they're not money makers, they're money losers and cash burners. And the only way they could make money is to raise it in the stock market. Well, not after 2022. So,
Yeah. So what does that mean? So like literally, what does that mean?
well, it means that instead of saying we can sell another 1,000,000 shares to get us through the next 12 months, you're saying we're going to have to spend X amount that we've already raised during that time. And then, you're going to start cutting people. I mean, there's a cascading effect there, because then they stop being in hyper growth mode, which is all they know how to do. And then they start trying to rein themselves in. But that doesn't work. When you don't make money, when you lose money on every unit you produce of whatever you're producing, you got to find a way to raise the cash, or you need to start making money, and that's not going to happen. It's just, there's no way out of not making money. And you have a pile of cash in the bank, and then you run it down because you have to stay alive.
So
really is that.
explain, can you get behind the scenes on Silicon Valley Bank? And like everyone calls it SVB. So
Right.
like, let's just go with the acronym.
Yeah. So SVB is just what I just explained, right? They cater to all the startups. And when the startups stock values, equity values were absolutely murdered in 2022, really starting in 2021, a lot of these are the companies that peaked at various times throughout 2021. Like the ARC Innovation Fund, Kathy Wood's fund, a lot of those money losing companies were in there. That peaked February 2021. So that's been 2 years already. So, it's 2 years of having a real hard time, or actually most of that time being impossible to raise more money in the stock market. And, maybe having a loan to pay back, and having just whatever cash you raised on your IPO, and that's all you have left. So, and even companies that are, not in danger, like I think Roku and Roblox came out with announcements that said they had, it was in each case, it was something like 20 or 25% of their cash in SVB. So, even if you're kind of okay, there's a lot of impact with it. And
Maybe it would be helpful to explain how that happens. So there's like these like Roku and even we've heard a lot of news about Uber lately. Like SVB is an influential bank in the region. What's the difference between capital invested in and outlet? Like that's really interesting, because the people who are trying to invest in new ideas, they're really buying marketing. They're not actually buying the financial health of the bank. And I think that's the real answer, is SVB was funding a lot of alternative or maybe tech investments, but they're not actually making any return on that.
Well, to the extent to which they, made loans, you could say they were trying to earn some type of return, but, I think a lot of those loans are, some of them are probably worth zero, and a lot of them are worth less than par. That's your return. And then whatever you can do with the deposits that you get. They were profitable before they had to report reality, right? Like it looked profitable.
That's what I want to know, is like, explain the report reality, because that's kind of interesting.
Yeah, it is interesting. I heard one person put it this way: if you had to mark everything to the market, all their securities, all their held to maturity type securities, all the treasuries and MBS and everything, they were probably insolvent in November. They were insolvent in their last report. So, but you don't have to do that. So that was when we started hearing about the bank run. And then of course, that just got way out of hand. People started realizing that they're basic. It's very basic. It's like, finance 101, assets couldn't cover liabilities, and people started getting nervous about it. So they went to the bank, or there were some pictures of people standing in line at the bank, but really, online, and withdrew and transferred everything that they could. I saw stories of people who actually did get out, everything over $250,000. But obviously at the moment of seizure, I think I've heard 85 and 90% of the accounts were over $250,000. So in other words, those are all technically, uninsured, just unsecured liabilities, right? But we know they're going to be backstopped now.
All right, so I have a couple questions. One is like, how does it happen all at once? Like,
Yeah, well,
the
it's
buildup is what it is, right? And
yeah.
we all kind of like it, especially in our world. We know what's happening, but then it happened. I mean, that was a rapid decline. And I'll just give you an example. And all right, now I have three
Yeah.
questions. The first one was, you could buy 1-year treasuries on Thursday, which is what are we talking about? 4 days ago on the trading market for 5.2, almost 5.25. And now they sell for less than zero. So they collapsed all at once because of the fear of a banking rout. Like, how does
Right.
that happen? Like, seriously, how does that happen? It happens fast.
Yeah. So the speed, this is Ernest Hemingway covered this in Sun Also Rises, how did you go bankrupt? And the answer comes
All
two
at once.
ways. Gradually, then suddenly is the answer. And that's how it works. I was pretty bad off as a young man. I had spent too much money, and I knew it was happening. And then all of a sudden one day I thought, oh man, I got a real problem. And I dug myself out of it. But wow. So I experienced it firsthand in a very small way as a very young man. You continue paying what you can pay, right? You just continue doing what you can do until the absolute moment when you either do not have another single dollar at your disposal, or in this case, you're in a regulated industry. You do what you can do until the moment when regulators see crystal clear, this is not going to work. You're insolvent. We're declaring you insolvent, even if you can pay another bill in the next 5 minutes. And then it's over. Gradually, then suddenly. And the losses, I mean, it took a year for treasuries to have their worst year ever. So that was a 12-month process. Meanwhile, everybody's saying their treasuries, their mortgage-backed securities, they're fine. Yes, SVB owns 6 times more than the peer average of the industry, but it's okay. We have more than half of our assets in this stuff, but it's okay. They're MBS and treasuries. How bad could it be? Minus 30% is how bad it could be. And once something like that happens, you just
Let's get into the anatomy of the trade. So I was actually my personal money. I was trying to invest in 1-year treasuries 4 days ago
Mhm.
because they would have paid whatever 5.2. And then today they pay less than zero. So how does that happen?
Well, it happens, because it's fairly short-term money, and fairly short-term safe money is where people go when they're scared. And people are, there is a certain amount of panic. We've seen the action in the market, just in the stock market and in the banking sector. The whole, all the banking ETFs and all the bank stocks have had a really rough few days, even though really, like, are all banks startup banks in Silicon Valley? No, they're not. Are they all crypto banks? No, they're not. Signature was into crypto. No, they're not. So this is
So do you think that the banks that are they're having trouble right now, let's just be polite about it.
mhm.
Do you think that they were overly leveraged crypto? Because I wanted to ask that question of somebody who studies.
Yeah. You know, it's funny because Silvergate was another one, and
Yeah, that's another
like
one.
I was always terrified of Silvergate. Like I was so terrified of
What
it. I
reason
just
then? Why? Why?
because of the word crypto. The word crypto terrifies me. I'm like, wait a minute, wait a minute, wait a minute. You're a bank and you're taking deposits in crypto? How's that going to work out? Because we've seen, look, you could just take the biggest, you know, the blue chip crypto, right? Bitcoin. It trades like a worthless bio, what? Yeah, it
No, it
trades,
trades up and down. Is
yeah,
what
it trades like a worthless biotech stock. You know, it trades on nothing. It trades like the most speculative, risky thing on the face of the planet, which, as far as anybody can tell, it kind of is. Right? I mean, I sort of hope it works. I'm sympathetic to the idea, very much so. I mean, we had it in in the newsletter, Extreme Value, for some time and did okay with it. But you know, it trades like any highly risky tech stock. So as soon and then so that's the one that might be worth something, and then all the rest of this other garbage is probably worthless. So when you tell me a bank is going to take deposits in this stuff, I think to myself, oh my God, how is this going to work out? And I never did understand it. I never did understand exactly what Silvergate thought its business model really was.
That's a good place to start, because let's start with Silvergate and then Silicon Valley, and then you have Signature. Signature is a retail banker,
Mhm.
and they're getting hammered now, which is not, that's not healthy for the broader market. So that's the word that everyone wants to use right now. Is it a contagion, or Biden's speech? I think it was yesterday, maybe, where
Yeah.
the banking system is safe.
Yeah. Ooh, I wish they wouldn't say that, because
Yeah,
every time they do, it's like, you know, it's true.
what the fuck does the president know
Yeah.
about the banking system?
Oh, enough to be dangerous, but not enough to be truly useful. So, you know, I heard that, I don't know if you saw on Twitter, this clip was going around of Jen Psaki from her new TV show on MSNBC. She was saying, and she knows this because she was the press secretary. She said, Biden doesn't do anything before 9 a.m. He doesn't do anything at 9 a.m. in the morning. He's a night owl. He's not up at that time, or he's not doing anything at that time. So to get him up at 9 a.m. to stand in front of a microphone and read this thing that says the banking system is okay, they must have really thought something terrible is happening. And it's Shakespearean, right? Methinks the lady doth protest too much, methinks. So it's suspicious, at least. It's, you know,
No, but I think it's also true.
it probably is true. But if it's not, the culprit is not crypto. The culprit is treasuries, because they're all hanging on to it. They're
Yeah,
all holding to maturity.
yeah.
You know,
I was kind of going in that direction anyway.
Yeah.
That the real issue is the banks have not been able to calculate the rate at which interest rates have been raised by the Fed. The overnight rate. Like they're caught in that trap.
Yeah, I mean, they know if they're losing money because, you know, rates are inverted, or whatever, the curve is inverted. They know how much they're losing. I promise. They're not going to tell you if they can avoid it, but they know. So, because they know what their assets are, they know what their liabilities are.
They get caught that fast. How do they get caught in 48 hours? Come on.
When we're talking about people caught in 48 hours, again, it's, you know, we're talking about gradually and suddenly. We're talking about somebody like the executives. They were selling stock ahead of time. They were paying bonuses. They were doing everything as normally as they could for as long as they could.
Did you hear that was one of the news reports? They got paid bonuses like 7 hours before. Come on, man.
Yep. So don't fool yourself. They knew what was going on, and they were trying to, you know, issue themselves a golden parachute. I don't know if it'll be clawed back, but it probably should, right?
I'm not in favor of clawing anything back.
That's fair. The clawback should come from shareholders, not from the government.
That you guys fucked up and we want our money back. I'd be okay with that.
Absolutely. They own the company. They should be able to vote and say, no. We vote no this time around.
That takes a couple quarters at least.
Yeah. In fact, I think I think people calling for, bailing out all the depositors, even over 250 grand and all this stuff, I just think it's insidious. They just didn't learn from 2008. They didn't learn anything from 2008. That, in fact, it shows you the degree.
I could go on about the interest rate level, and I will.
Yeah. Okay. Do.
Not right now.
Oh, okay.
But I think that's the problem, is that they're trying to regulate people's risk levels by dropping the rate at different times or whatever. So,
Mhm.
so maybe a great question for you right now is, what are they going to do on March 20th? Are they going to raise the rate by 50%? Because they say they're data driven.
Yeah.
Hold on, don't answer.
I know what you're going to say, but go ahead.
They say they're data driven and they have all this employment information,
Mhm.
and yet they've got a banking crisis on their hands. They're
Yeah.
going to drop rates, aren't they?
They're going to do what?
I think they're either going to not raise rates or drop them.
No, I think they're going to raise them 25 bips. 25 bips says, look, core is hot. Core inflation is hot. 5.5 is a hot number.
So this would be the crux for me, is the real goal is to save Wall Street.
Yeah, it's the Fed's mission is the socialization of risk since 1914, since it opened for business. Yes, that is
why is
a
that going to
primary.
be different like 2 weeks from now? Or
Well, they've got a narrative to run here, buddy. They've got a story to tell, man. We're the inflation fighters. We still have to, we still have to tighten. But yeah, 25 bips and all this 50, 75 bips. It was nonsense. They should have raised it 200 or 300 right out of the gate.
Yeah.
Or hey, here's an insane idea. Let the market set rates and quit manipulating the bond market.
That's crazy. What, Dan
Yeah.
Ferris, did you just say that?
Yeah. Would the market have gone zero? Would the market have instituted its version of ZERP for years and years? No. People want to get a return on their money, and all the Fed did was, in fact, the whole financial system, the status quo is the encouragement of speculation, right? It's the promotion of speculation, of moving money around so that folks can kind of take something off the top.
What I would say would be a number of issues in the banking system where people were taking advantage or leveraging up low interest rates for a long period of time, and they thought that would be the norm.
Mm-hmm.
And it feels like Silvergate was one of those, Silicon Valley was one of those. Like, let's not blame crypto for it.
No. Yeah, if there's a systemic issue, I believe it is simply it's the whole issue of this whole massive mega bubble, which is just cheap money. All of the stimulus and deposits and extra money that was, the government borrows money, it prints it. That's how it, the US government prints money by borrowing it. So they issued all that debt and sent out PPP checks and stimulus checks and spent money outright due to the pandemic, due really to the lockdown of the pandemic. And all of that, if you look at bank deposits, I mean, it just goes parabolic, and now it's crashed. So all those deposits went out, and suddenly banks are flush with these deposits. So what do? Well, they're paying diddly squat on them. So it's good, cheap money. Yay us. Unfortunately, right around that time, during 2020, the biggest asset bubble in all recorded history was peaking, the bond market bubble, the interest rate bubble, really, right? So, I think it was March, I can't remember the date. I want to say 9th or 10th, something like that. In March of 2020, the 10-year trades below 40 bips of yield, right? And the fact that, and then I think again below 50 bips of yield in August. And then all of the negative yielding debt of all these sovereigns in Europe, Japan, et cetera, all around the world, was a peak of 18.4 trillion in December, right? So that's all means extremely low rates, extremely cheap money is everywhere. Unfortunately, at that time, right, all these banks were just had deposits shoved at them. And so it was extremely cheap money because they didn't have to pay anything because they're not paying anything on deposits, right?
I want to like be very clear
Mm-hmm.
about what happens because I've been trying to explain this myself, and I think you're doing a good job right now. But it's very clear to me that when the rates are extremely low for an extended period of time,
Mm-hmm.
which is literally policy driven, it's not actually a market thing.
Mm-hmm.
When those rates are low for as long as they have been, then banks made mistakes.
Yeah, I'll say that everybody did. Everybody who had capital to allocate, right? I mean, it is making it impossible for people to get a decent return, a safe return on savings encourages speculation. They got it. They go up, in risk, right? So they put more money into the stock market, and then stocks go up, and they're don't think they can make more on Apple or Google or whatever. So then they buy the next tier down, and the next tier in quality down, and the next one down, 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 and then you get to 2020 and 2021 with all the worst garbage peaking at after enormous run-ups. I think ARK Innovation ETF, which is really the poster child of all that, I think it was up like 158%, I want to say, in 2022, maybe to the peak in early 2021. I mean, enormous, 10 or 14 month return, enormous. It's just, those businesses didn't increase in value by that much. I mean, their economic footprint, some of them probably shrunk during that time because they're all losing money. So yeah, it's an inducement to gamble, and the stock market becomes this crazy thing where we get meme stocks where people think that they're going to go to the moon, and people are buying stuff like AMC, and you and I both look at that and we go, well, it's a dying business in a declining industry, and it's got tons of debt. What's going to happen? And oh, by the way, they really kind of doubled their share count with these new securities, and that we know what happens after that. It's just like everything turns into a biotech stock or a penny mining stock.
All right.
And
So what do
so,
you
yeah,
do in what's the alternative? Like
the
you and I
yeah,
are both asking that question. So
yeah, the alternative makes you look like an idiot while it's all still going up. The alternative is Dan saying you better hold plenty of cash in years like 2019 and
how,
2020.
but that's a good question. How do you hold cash when the dollar itself is in question?
That is I'm glad you said that. Holding cash is, of course, in part a direct bet on the value of the US dollar, admittedly. However, holding cash is a stable option with no expiration. There's no theta, there's no time decay, really. Yes, there's the time decay of inflation, but let me ask you something, Addison. How would you feel if you had everything in cash, in early 2020 until this moment? You'd be hailed as a genius, a little bit of cash, a lot of cash, a little bit of gold or silver or something,
Thank you, Dan.
yeah. so so yeah, you're welcome. Me too. I mean, so yeah, what you do during that time is you look foolish, and you do foolish things and say foolish things and tell people you better be careful, this never ends well. I mean, I told on November 19th, 2021, we published it in the digest. I said, I've never been this bearish in my entire life. It was the day the NASDAQ peaked. I said, you better buy some put options. You better be careful. You're going to get run over by a train. I mean, it just pounded the table. I couldn't believe what was happening. And, we know how it all has turned out. But yeah, the answer is you look foolish until you don't, to
Yeah.
your question.
So what's next for you?
What's next for me is a couple of things. Like, one of the things I try to do is be the person who entertains extreme scenarios, extreme risk scenarios, because I don't think enough people do. I try to think about systemic risk and big cycles. So
Right.
I've been,
So that's one of the one I wanted to talk about is one of the ones I wanted to talk about is the big cycles, because I am more interested like history. I'm just interested in history. And I feel like we're living through an historic period,
yes,
and people will write about this later and they'll be like, oh yeah, that's what happened at that time. But if you can extrapolate forward historical periods and make decisions, that's how people make money, a lot of money.
yes, yep. Yeah, people say it's different this time, it's not different this time, and all that. If you understand that it's like never different this time, it really helps. We never have a massive financial mega bubble without serious pain for quite some time afterward. So this time, I think there is at least some potential for the United States to have is experiencing its kind of peak Japan type moment, where the market goes sideways and doesn't make a new high for 10 years at least, if not 20. Japan's into more than 3 decades of that now. That the market still hasn't returned to its
I think
1989
they're
high.
in for.
What is it? 34? Yeah,
No, I think they're in.
1989, 34. Yeah. Yeah,
Yep.
that's right. 34 years since 1989. So I think there's potential for that. And I think that, the bear market, like run of the mill garden varieties type bear market after a massive bubble, would take the S&P 500 down 75% from the January 2022 peak. I
That's
mean, nobody's thinking
is,
about,
wait, hold on. That is a crazy statement
it
because
is.
I was thinking 30%. And I did the math and I'm like, holy shit, that would mean massive turmoil for most 401k holders,
Yep.
most IRA holders,
Mhm.
most people that are like, I don't really care, I just put my money in the market. 70%
Yeah.
would be twice what I was thinking.
Yep. And again, I think the mistake that there's a big potential to make a certain mistake here, to look at all bear markets and try to average it out and say, oh, well, we're probably there, it's probably not much worse than this. But not every bear market is preceded by the biggest financial mega bubble in all recorded history. Did I say
Well,
that enough
that's
times
also
yet?
that is also true because if you like I was saying 30%, whatever, and then I looked and all that did was take us back to 2020. So like if you do the math,
Mm-hmm.
um, a bear market of 30% right now
Right,
would take us back to 2020, like
right,
pre-pandemic levels.
right.
But
Um,
what you're talking about is like a larger sort of cyclical bear market that might take us back to what, like late, I don't know, 50s? Like I
you
don't
know,
even know the math on that.
yeah, the last time I personally, let's see, let me grab a quick chart. The last time it's 1200 on the S&P 500. So the last time we saw that was, looks like, oh, darn it. I hit the wrong button here. Sorry. Um, Last time we saw 1200. Um, Looks,
It's going to be like early 2000s, right?
yeah, I've just messed up this chart that I don't know how to use. Um, yeah, so anyway, what you said. No, actually, it looks like somewhere around June 2011, something like that. And that actually, that's a little more than
I
a
would have
decade.
thought it was earlier.
Pardon?
I just would have thought it was earlier. That's it.
Yeah, yeah. So just call it June 2011, around 1200. So, I mean, that lops a decade or more than a decade off your off your returns, your compounding, your wealth
All
that
right,
you've
so
built
let's
up.
talk about that. Like, how do you think about where to put your money in a situation where we feel like the market is topped out and might not do so well in the next few years? Like, you can't buy high and expect to get returns lower.
Right.
So what do you do in that?
Okay. So we look at, there technically, I don't think is enough data to really look back historically. So anecdotally, I'll just say, some work was done on the sort of sideways, the brutal sideways action in Japan for many years. And it was found that a sort of quantitative systematic value system, buying stuff that was cheap by price to free cash flow, price to cash flow, price to book, price to earnings, things like that, the traditional value metrics, produced excellent returns over
Even in Japan.
in Japan. Yeah.
Mhm.
So, we do have this example of, in other words, a multi-decade sideways market. And we know that buying when the value metrics are cheap works. And it was systematically selling every 2 years, I believe, every year or two. I don't remember the exact study, but the parameters. But I know they were buying based on those metrics, and the returns were pretty phenomenal in various types of stocks like mid, small, large cap, et cetera. So that's one thing. You're going to buy value. You're going to look for what's cheap overall. And you can do that with almost any decent value fund. And the value funds, they look like, if you take a value S&P 500 and a growth S&P 500, they overlap so much, you go, how can that work? But it does over time. And you can see also, if you plot these things as I have, you can see them just like, it's like the tick-tock of history. Value outperforms for a while, then growth outperforms for a while, which is the period we just had since 2009. And now I think we're in a growth outperformance period. So that's one idea, value. Another one is commodities. Commodities are, in addition to bonds, I think they're the big sort of macro sensitive, rate sensitive kind of asset that people need to understand, which they tend to not understand it because prices can fall for a long time, but then we get these big turns and value starts working, and a lot of those value names are commodity producers, oil and gas producers, miners, et cetera.
Yeah.
And
Yeah. So my um uh, how do I say it? We've known each other for a long time, and I know Rick Rule. He's a buddy of yours
yeah,
and mine. Like, we've been talking about commodities for a long time,
mm-hmm.
and we keep saying buy them, but why do we say buy them if the market doesn't change? So that is a very specific question, because I think people think more short term than the way that we talk about buying commodities.
Yeah. I mean, admittedly, even in a good long cycle, like just use the 70s because it's too easy of an example. Even in a good long, commodities bull market cycle that lasts a decade or more, there was a massive recession in the middle of that. People forget that. Arthur Burns did succeed in creating a recession. He just didn't go far enough for political reasons. And so yes, it's volatile. There's more volatility in commodities than there is in other things, in bonds, in
Yeah,
stocks.
I kind of want to hear you say something like, um, over the long term, if you invest in the building blocks of all the stuff that's around us,
Right.
like the commodities that we use to build computers and microphones and phones and cars and
Right.
stuff like that. Why
So,
doesn't that work?
well, the reason why commodities don't work is that it shouldn't. They should always fall in, they
Oh,
should
right.
fall in value over time.
Yeah.
That's a good thing, right? When they fall in value over time. That's what we want. We like that. That means we have a higher standard of living. but our currency being what it is and central banks being what they are, cycles will happen. And we get into these predicaments where, there's too much leverage, financial assets are suffering and look like they're not going to do great for a while. And it just so happens at those times that so-called real assets or hard assets tend to do better. And I think we're at the beginning. Anybody who thinks like oil is done and the commodities run that we had is done, I don't think so. I think this is the beginning. And I think we're looking not at a super cycle, but at a hyper cycle, because commodities have the wind at their back 2 or 3 different ways. First of all, we are genuinely short of them. We haven't found big new copper mines recently, and we haven't found, big new, practically fill in the blanks, big new anything recently. And we are, oil and gas companies are getting mixed signals from governments about this green energy transition, but their investments are like 20-year investments. They don't want to do that. So, and investors aren't stupid. They say, you pay us more dividends and share repurchases, please. We want the cash now because we don't trust what's going to happen in the future. And I made a chart that I put in the Ferris report newsletter, and you could see like all the biggest, oil and gas companies, their capital expenditures just like down over the past, I think it was like 5 or 7 years or something.
So why is that? Because they're afraid that those expenditures are just not going to pay off?
What would you do, Addison? I'm going to say, hey, we are going to put you out of business one day.
But
yeah, we are going to put you out of business one day, but we need you to produce right now. That's the message. And we hate you, by the way. We blame you for the destruction of the planet or something, it's all ridiculous, but that's the narrative. That's what's happening in politics and in the market. So,
does that mean a buying opportunity for oil companies or natural gas or shipping companies or whatever?
Producers, oil and gas producers, right? Miners, people like mining companies. I have, one of the companies I recommended, it has more reserves of a certain key metal in the green energy transition than anybody in the world. And it's a certain metal that people just aren't finding big enough deposits of lately. So that's a great one, right? Because finding new mining deposits and then bringing them to production is a process that can take decades, So it's not something you start up quickly. It's not like eBay and you do the code in your garage over a weekend and then you have a business on Monday. It's not like that at all. So yes, there is, we have not produced, we don't have enough of any of these things, and certainly not enough to supply this transition to electric vehicles and all these other technologies that aren't nearly as great as what we're being told.
You talk about like lithium or cobalt or nickel, like the things that we don't have.
Yep. Yeah. Copper, lithium, nickel, cobalt, all that stuff.
And all the places that we know that they exist or we don't even know that they exist yet are in politically untenable places.
Yeah. Oh, there's that too. It's not a freewheeling entrepreneurial society like Silicon Valley, 25 years ago. Used to be 25 years ago.
Say that.
It's Africa. I mean,
well, it's places like Greenland and
places where or the United States. We have plenty of metal in the ground in the United States, but you're probably not going to get a lot of it out. So.
All right, so let's get to the meat of it. Like, how do you invest in this stuff? Like, tell me what you would want readers to like take from your work.
What I would want them to take from my work is that to get a really nice return on this, Rick Rule calls it capturing the beta. In other words, if you just get the market return for commodities over the next several years, you're probably going to do great. You don't have to swing for the fences and buy a whole lot of risky companies. You can buy all the like blue chip mining and commodity producing companies, and you'll probably be, I think you have a very good chances of making an excellent return.
What would the
So those are the
beta
ones.
rate be? Like 20%, 22%?
Yeah, fat double digits, teens to mid 20s, high teens to mid 20s per year.
But that's
Next,
not bad. I was just excited about 5.25 treasury rates.
right,
like,
right.
like you can make money when the market goes south.
Yeah, that's a sensible view, by the way. It is good to get excited about 5% treasuries after all this time. But I think you can do better in commodities because, in addition to the other things, the lack of supply, the green energy push, just good old fashioned inflation, I think is probably stickier and longer lasting than anyone today thinks. And rates are higher for longer, more so than anyone thinks.
But inflation also means that prices for commodities will go up as well.
Right. The real point of it, as you well know, is that, the price goes up because the thing you're buying it with is falling in value, right? So that affects everything. And you know how inflation has been during our lifetime. It's like you never know quite where it's going to pop up, and then one day you realize, oh, it's in the stock market, isn't it? Or it's in the bond market, or
real estate. I mean, it's where
and really, yeah,
big time,
exactly.
which is okay by me.
Yeah, I know.
I
It's
have
okay with
some.
me too.
All right, cool, man. Dan, it's been a while. We got to
Yeah. Yeah, it's been too long. We should do this more regularly.
Yeah, it sounds good to me.
Yeah.
And it's nice to see that we're on the same page after whatever many years and miles.
I know, old guys, a lot of old guys are on the
I
same
don't
page
know
right
how,
now.
like, I'm impressed by your I don't know, you got a like coiffed goatee thing going.
I look in the mirror and
can't do that.
sometimes I think I look like Santa Claus. But my wife
Well,
gave
not
me
really though. You look
yeah.
like one of those advertisements for like just for men.
Right. I know what you're talking about. Yeah. My wife gave me this thing, and it's just like
It works.
yeah, anybody can do it. You just
Yeah.
and you're done. So
I can't even grow it. So
yeah.
all right,
I'm
cool,
thinking
man.
like, all right.